round of applause to Christina Garza.
That's me. Thank you guys so much. I'm Christina Garza, and I'm the owner of AccountingProse. We started in Phoenix, Arizona, but we're now in Denver, Colorado, and really all over the United States. We have a heavy focus right now on fitness, not just because it's a great business to be in, but because we absolutely love it. I have a really unique group of accountants that I've hired. I have a former CrossFit Level 1 coach. I have a Zumba instructor. I have a person who practices judo on the reg. We tell people if you don't give us your document, she's going to put you in a triangle choke. And then I've got a guy who, as an adult, learned how to dunk. And he's not an enormous dude, so I think that's pretty fantastic. So we all have a deep love for fitness, which is why we're in this space. So for the next 4 to 6 hours, we'll be talking about accounting compliance. I hope you guys are ready to buckle up. We're going to talk about sales tax audits. No? Nobody? Okay, good. We're not going to be doing that. Oh, there we go. So I'm just going to get this out right away. Accounting, I'm sure everybody in this room thinks that accounting is incredibly boring. Not everybody got into the business because they love the numbers, they love doing the books. You got into this business because you absolutely love working with your clients, right? But we can't forget about accounting. It needs to happen because it's a lifeblood of the business. You need to understand how your business is actually doing so that you can make plans for the future, right? And I'll start off by giving you some really sad facts, and I want you guys to be the opposite of this. So 30% of businesses fail in the first year. 50% of businesses fail in the second year, and 66% of businesses fail in the 10 years of owning the business. And this isn't stuff that I'm making up. This is from the Small Business Association. So you here all need to be the minority. You don't need to be that 66%. You need to be the opposite, right? So what is the number one reason that businesses fail? Money. People aren't stacking that paper, or they're not planning for the future. You need to make sure that you have a firm understanding of your money. And this isn't just money coming in the door. This is also money going out the door, right? You need to make sure that you're planning for your future. So the way that you can keep money in the business and keep your business going is by running the business by the numbers. And what does that mean? So in the 8 years of running AccountingProse and all the years of accounting before that, I've run across every single situation that you can ever think of. I had a construction company who was going through an audit, and they gave me 2 trash bags full of receipts and told me to figure it out. And they gave me like a week to do it. And that's exactly opposite of the way that you'd like to run your business, right? We also have people who are trying to get a loan from the bank, and they can't do it because they don't have a good set of financials to hand to that bank, or their tax return doesn't match their books. And then I ask those people, what have you been doing for the past few years? How have you been running your business? And they tell me that they're looking at the ending balance in their bank account at the end of the month to figure out who they should be paying. That's not a good way to run your business, right? That doesn't give you the complete story of your business. That only gives you a small fraction. That's just one very minute part of the business. If you're running the business by the bank account, you're not able to see the full picture. So for example, who owes you money? That's accounts receivable. That's a fancy accounting word for who owes you money. If you're running the business by the bank balance, you actually don't have any clue about who owes you money because that's not reflected there. Same thing with how much money you owe to other people, so accounts payable. That's also not going to be reflected in your bank balance, so why would you want to run your business that way? It's also could be full of errors. So I don't know about you, but if you're handwriting out your bank balance or you're doing a checkbook register, it's probably going to have errors in it, right? You'll be missing information, you could be duplicating information, and at the end of the day, it's not going to give you the right information at all. You also can't slice and dice your information. You're just looking at one piece, you're just looking at one number, which is how much do I have left over at the end of the month. It doesn't tell me who I paid, who paid me, where that money went, where that money came from. It's really not giving you much information at all. And finally, it's usually last minute. Like that guy who gave me a bag full of receipts and said, figure it out. He's only doing that because he has some serious issue right now, which is he needs to pass some sort of audit. He needs to make sure that he doesn't have more money flying out the door. So and I won't bore you too much, when I start to see your eyes start to glaze over, I'll just move along. But I hope that you guys, as business owners, have some sort of accounting system set up. We use Xero, and some of my clients in the room also use Xero. That's the only accounting software that we support. They're a direct competitor to QuickBooks. You don't need a degree in accounting in order to use Xero. I think it's very simple and easy to use. But as you're thinking about getting a good set of numbers set up, you need to set the framework first. So think about the ways that you earn money in your business. Instead of having everything lumped into an income account, you're going to want to have things broken out by how the money is coming in. So for example, if you offer group training, you should have an income account for group training. If you sell supplements, you should have something for supplements. And it goes on and on. And then beyond that, you should have expenses that tie related to that. So if you've got group expense income coming in, you also have costs, right? It's impossible to figure out whether or not that part of your business is working for you if you're not tracking against income and expense properly. And everything that you do in the chart of accounts, whether it's money that's going out, money that's coming in, it's all going to the final result. As you're reconciling your accounts throughout the month, or using the app and swiping, whatever way that you do in order to get those numbers in, they're all to do one thing, which is to create financial statements. And the two financial statements that you need to be using or looking at every single month are income statement and balance sheet. Income statement is what's on the screen now. It's really tiny, but I'll just explain it to you briefly. Income statement is going to tell me whether or not I've made money at the end of the month. And this is super important because if you are, again, looking at your bank balance, it's not going to tell you much. It's just going to tell you how much you have left over. And if you want to be one of the top performing businesses who make over $1 million a year, then you're going to need to do this. Did you guys know that only 2% of women-owned businesses make it beyond $1 million a year? That's abysmal. That's insane. You need to be making more money than that, right? If you want to be successful, you want to be able to retire early, you need to make more money. So you need to be paying attention. So the income statement's going to tell you how much revenue you brought in, the costs related to producing that revenue, and any expenses that you have running the business. So there's a quick calculation if you want to write it down. Revenue minus cost of goods sold is going to be your gross profit. Below that is going to be your operating expense. So revenue minus gross profit minus operating expense is what's left at the end of the month. What did you actually make in the business? What are you keeping? And the next financial statement that we issue to our clients is a balance sheet. The income statement is going to be a picture in time. It's going to you can slice and dice it by month, by year, by quarter, whatever you want. Balance sheet's going to be a point in time as of today, as of yesterday, as of last year, and it's going to show you your what you own, what you owe, and what the equity is in your business. What you own are things that you own: current assets, long-term assets. Does everybody know the difference between a current asset and long-term asset? I won't bore you too much. Current assets are what you use in the next 12 months. Long-term are what you're going to use after 12 months. And I'm going to tell you why that's important in just a few minutes. And what you owe are going to be liabilities. Liabilities are what you need to pay out to people. So that's going to be vendors, accounts payable. That's going to be mortgages, things like that. And then we've got long-term assets as well, like fixed assets. What are you going to tie that to? A mortgage. You need to see those two things together. And at the end of the day, you also have equity. Equity is going to be your financial stake in the business. And that's not just you, it's your partners as well. So those need to be segregated on there. And just like the income statement, there's also a calculation that you can tell whether or not things are working. It's the balance sheet, so it must balance. So assets equals liabilities plus equity. If you see those numbers not lining up, that means your accountant's doing things backwards. They're doing things completely wrong. Or they're trying to do it on a scrap of paper or a spreadsheet or something like that. So not only are you looking at how much money you're bringing in the door, but you're actually looking at the whole picture. So let me tell you, if you made $1 million a year, congratulations. You should be patting yourself on the back because you're probably one of the few people who are actually doing that. But if you're making $1 million and you're keeping no dollars, then you're in big trouble. It's not I would rather not give all of my money away. I'd actually like to keep some in-house. So beyond just looking at that big shiny number at the top of the screen, you also want to make sure that you've got something left over to pay yourself and for your future. So when your accountant hands you your financial statements, instead of letting your eyes glaze over and say like, oh, well, think about it another time, you need to actually understand what these things mean. We heard earlier that you can't just delegate and give things out. before you can delegate, before you can give your accounting out, you really need to understand the basics. You don't need to be an accounting super genius. You don't need to know everything A to Z of accounting, but you do need to know of whether or not your business is working for you or whether you're a slave to the business. And beyond that, not just looking at those big numbers on your financial statements, you need to also look at your trends of what's actually going on. So start to be curious and ask why. So for example, in order to see a trend, you need to look at 3 data points. So it's going to be perhaps last month, the month before, or the month before that. Or it could be last year and the 2 years prior, etc. And you're looking for things that are going to clue you into problems in the business or ways that the business is doing really well. But let's talk about problems in the business. All of a sudden, your expenses are starting to trend up, and you have no idea why. You don't have any money left over at the end of the month. You feel like you're doing really well, but you just don't have anything left. So what's going on? By looking at different trends in the business, you're able to understand where that money is actually going to. Or maybe income is trending down. If you're looking at your financial statements every single month, you'll actually be able to see trends of what's going to be a high point in the business, what's a low point in the business. And rather just like hiding in the closet or like putting your head in the sand and going, July sucks, we don't make any money in July, maybe now you can start to work on some initiatives for marketing so you can bring that money up during that month. Or maybe you start to hire less during the months that are really slow so that you're not actually spending money that you don't have. So looking for trends and patterns in the business is important. Looking at people who are paying you late. If you're just looking at the bank balance, you're not actually paying attention to who owes you money, you won't know when people are actually owe it to you. Or you're just maybe sending out a Word document as an invoice and putting the Word document in a folder that you never look at. You're never going to call those people and tell them to pay up. Same thing with outstanding bills. Maybe you're forgetting about paying your vendors. It's going to be really hard to negotiate terms with your client or with your vendors if you're not actually paying them on time. And that's something that you need to do in order to preserve cash flow in your business. And next is not having your expenses aligned with your income. If you're not making a bunch of money, but your expenses are super high, your direct costs are super high, something's wrong. So this is merely an exercise so that you can dig in and understand what's actually going on. Next is going to be around reviewing industry standard KPIs. So does everybody know what a KPI is? Key Performance Indicator? Okay, so I pulled some information from BizMiner and also from the Association of Fitness Studios, and hopefully you can read that. But these are the 4 things that our clients come to us and ask about all the time. How much should I be spending in direct costs or cost of goods sold? How much should I be paying my employees? How much should I be paying myself? And how much should I have in operating expenses? And so for 10,701 tax returns that were reviewed by BizMiner, these are the numbers that came up. So 23% is going to cost of goods sold. That means for every $100 that you spend $23 earning that money. For salaries, you're paying out 26%. So that's going to be your salaries, wages, taxes, things like that. If you're paying your people 40%, 50%, you need to back off and figure out what's not working and what is. Operating expense is going to be things like rent, advertising, office expenses, supplies, things like that. That's going to fall into that bucket. But the big bucket that people want to know is, how much should I be paying myself? As a small business owner, you need to be paying yourself your total compensation package, whether it's salaries or your distributions or anything like that, should be 23%. So if you make $1 million a year, you need to be paying yourself $230,000 a year in total compensation, and end-to-end everything that you're paying yourself. If you're making $1 million a year and you're paying yourself $50,000 a year, you're doing something wrong. So you need to figure it out. I know I don't work for free. I would like to retire young. I'm not too young, but young-ish. So I don't want to work until I'm 100 years old. And if I'm putting this much money in my bank and I need this much money in my bank to survive when I'm old and gray, well, I need to start fixing things now, right? So start to create the path. This is a way that you can create the path to success. And these are going to be some ratios that you should be paying attention to. These are also from BizMiner. And the current ratio is going to be a ratio for liquidity. And I told you a bit ago that I would explain why that's important to understand current assets and current liabilities. That's because you bring that information into this ratio. So in your industry, for every dollar that you're paying out to your vendors, so suppliers, et cetera, you have $1.43 to pay that back. This is average. If I'm a business owner and I want to feel comfortable with money going out the door, that means I want that number to go up. So my goal is to have it at 2% or 2.5%. I want to have more money in-house than I am going to be spending out. The quick ratio is going to be is going to include things that are more liquid. So current assets are going to be things that are exhausted in the first 12 months. Cash is going to be things that I'm going to have in hand tomorrow, right? So it's going to be cash and accounts receivable divided by current liabilities. And you'll notice that this number actually comes down a lot. So instead of having $1.43 for every $1 that I have owed to for my liabilities, I now have $1.06, and that number's actually comes down, which actually makes me feel pretty freaked out. I don't want to have that little amount of money in order to pay my vendors, right? So you don't need to be average, you need to be above average. And gross profit margin links back to your income statement we talked about a moment ago. Revenue minus cost of goods sold is gross profit. Revenue minus cost of goods sold divided by revenue is gross profit margin. The higher the number is, the better your margins are. If you're below 77%, that means you're below average. And you can very quickly just ask your accountant to do this calculation, or you can look at your income statement and do it on your own. It'll take 2 seconds to do, and it'll help you understand the health of your business right now. And these are coming in from the Association of Fitness Studios, and these are average. Just remember that. You want to be above average. For every square foot that you have in your business, and most businesses, most fitness studios range at around 3,800 square feet, $72 per square foot is what you can expect to receive. If you're average, you need to be double that. Revenue for client, this is going to be on average the $765. For group fitness classes, is actually a lot higher. It's closer to $2,000. But and this is something that you can tweak as well. If you start offering things like supplements, apparel, things like that, that number goes up, and that's what you want to look for. And revenue per employee is $37,948. I think that's incredibly low. You need to actually bring that up a lot higher if you want to be above average and be the 1% or 5%. You also need to be paying attention to non-financial KPIs. Non-financial KPIs actually drive your financial KPIs forward. So I heard a little bit earlier about some non-financial KPIs. These are the things that we are paying attention to. And if anybody wants my slides, I'm happy to give these to you. I know it's a lot of information, and I have a lot more. I didn't want to include all of the ratios in here, but there's hundreds that I can give you. And I can even drill down to area of the country or size of the business, et cetera. So I'm happy to provide that to you. Okay, so average class attendance. If you're tracking your KPIs over the course of a year and you see that your class attendance is dipping down, that means that something's wrong, right? You need to work on that. Client retention rate. Maybe you're really, really good at selling your clients, but you do an awful job of explaining what you actually do. So their expectation of what you're doing is actually way different than what you actually offer. So maybe there's a problem with messaging there. Maybe you're really great at getting leads because the Loudroomer team is just like flooding your inbox with leads, but you don't pick up the phone in the first minute, you don't return calls, your conversion rate is awful. Well, if you start to look at these trends over time, you'll see that, you might even feel it before that, and you can begin to work on that. And your conversion rate is going to affect your bottom line, essentially. And then customer satisfaction and employee satisfaction. Has anybody here ever, do you guys know what an NPS score is, Net Promoter Score? I'm sure everybody does. People love you, people don't love you. We want to pay attention to both of those things, right? You can use something like Yes Insights to send out a request and ask your clients what they think about you. But the important thing is that once you know what they think about you, that you actually act on it. That you take that information, take the ego out of it and say, all right, today I'm not doing so well, give it to me. And then you take that information and you run with it. And the same thing goes for your employees. Your employees are the biggest asset in your business. They're out there selling your services, they're training your clients, they're answering the phone, they're doing all the things that help bring you money. If your employees aren't happy and you have really high turnover, guess who else isn't happy? Your customers aren't happy. And beyond that, you're not happy because you're not making enough money. Your income's tanking. And finally, we need to make this a success a team effort. I know we all have heard there's no I in team. That's absolutely true. If you try to do this alone, it's going to feel like you're carrying the weight of the world on your shoulders. So some things that we've seen our clients do and that we've done really successfully is to build success into the company culture. So what does that mean? That means you don't need to open the kimono and tell your employees, down to the penny what you guys are making, but generally they should understand how the business is going. They're taking a risk by coming to work with a small business. They can go work for anybody, any of your competitors, and they can do a kick-ass job really anywhere. And so you want to make them feel confident that they've made the right choice by coming to work for your small business. So giving them an understanding of the KPIs that you're tracking and what they need to do to push the dial forward. So maybe you tell them, hey guys, we're having a really bad time with customer retention. We need to work on that. This is where we're at and this is where we need to be and these are the steps we need to get there. That'll make them feel confident that they've made the right choice and they're in the right spot and that you respect them enough to share that information with them. You can also do things like offer bonuses and incentives to them. You can say, hey, we're here now, we want to be here, but and you're going to help me get there, and once we get there, I'm going to pay you, a bonus, or I'm going to give you some other type of incentive. Or maybe you get a change of title in the business or something like that. Make sure that they're part of that process. And be really good about praising publicly. When somebody does an amazing job, don't keep it to yourself. They really need to know that they're doing great. So I tell people, this person did a great job. We got an amazing Yelp review. It's because of this effort that they've done that we're doing better now. And make sure that you keep any of your criticism private as well. Praise publicly, criticize privately. And also make sure that you're including other members of your team. And the members of your team can extend beyond your doors. It could be you, it could be your co-founders, it could be your wife or your husband. It could also be your accounting team. If you have an accounting team who's really nerdy and likes to visualize all these things, tell them what you're trying to do, and they might end up giving you a KPI board that tells you that visually represents how things are going in the business. Or they'll give you charts and graphs and stuff to get you really excited about running the business. So make sure it's not just you. There's no I in team. Don't do it alone. And this is my final slide, so I promise I won't bore you too much, but this is the sappy part of the slide. So I actually put a concentric circle on the slide. It's really easy to feel like your business only affects you. I'm sure it's a little bit different in the fitness industry because you can actually see the results on the person in front of you. But the results isn't just going to be about you, and it's not just going to be about your client. It's going to be about the world around you. So when your business succeeds, you help your clients, you help your staff, you help the community, you help the world as a whole, really. You help to reduce the obesity epidemic. It's not just about you, after all. So recognize your role in this space and know that your success is going to help everybody and your failure hurts a lot too. You owe it to yourself, you owe it to your clients, you owe it to your employees to run the business by the numbers and be as successful as possible so you can bring everybody up around you. Thank you. That's all I've got.